Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Markets Wrap, where we talk about the biggest moves in markets this week and what is driving them. I'm Merryn Somerset Webb, editor-at-large at Bloomberg UK Wealth.
And I'm John Stepek, senior reporter at Bloomberg and the author of the Money Distilled newsletter.
John, inflation. I'm slightly bored by talking about inflation. We've now been talking about inflation relentlessly, you and me, for, 25 years.
Yeah.
Actually, I mean, more intensely for the last few, admittedly, but nonetheless, the conversation hasn't gone away. We've had the UK inflation numbers. What did they say?
There really isn't much to tell. It came in at 3.4% today, which was the same as last month. Last month it was meant to be 3.5, but they got the wrong vehicle excise duty numbers, so it was actually 3.4. And actually, the most semi-interesting thing is that in about a year's time, if inflation is still above 3%, and it probably will be looking at the arithmetic, then we'll have been above target for almost 5 years, almost 5 years non-stop nearly. And so you're kind of at the point where people are starting to think, wait a minute, inflation's always 3% or more, and that starts to influence their behaviour, or at least in economic theory it does, and so possibly that will be at the back of the Bank of England's mind in terms of when it sets interest rates.
Yeah, although I suppose what also should be at the back of the Bank of England's mind is the catastrophic failure of their policies.
I think that is always somewhere miles away at the back of the Bank of England's mind. In fact, possibly in a filing cabinet marked "Do Not Open," lest cognitive dissonance afflict you too heavily.
And a long, long way away from the filing cabinet that says, how about we change that inflation target, eh? Wouldn't 3% be a little better? Because then we might not mess it up so badly. If it's going to be 3%, change the target to 3%.
Oh, that's
follow reality.
I think, but part of the point of financial repression, if you can even get it going, is to pretend that the inflation target is 2%, but it's actually 3%. I think the rest of us should maybe think of it as being
John,
like that.
do you think that the actual target is 3%? Conspiracy theory alert.
No, it's not a conspiracy. It's more just it would be helpful if it was 3%. We'd like it to be 2%, but we won't try too hard. I mean, the fact that it's 3.5% nearly, and they're still saying we want to cut rates.
Yeah.
So I mean, if they were that serious, or rather, if they believed that their tools would push it down, then you would think they'd be talking about putting it up rather than putting it down.
I don't want to dwell on
No, we
this.
shouldn't go on this too much.
No, I don't want to say one more thing about it all, but put out one more thought, which is that, we've talked about financial repression, you and I, so much over the years, and our wonderful regular guest, Russell Napier, comes on, he talks about financial repression, and when we talk about financial repression, i.e. keeping interest rates below the level of inflation, obviously we haven't got there, but we talk about this idea that inflation would be higher than target for maybe a decade or something as a way to try and sort out the UK debt situation, but that predicated on controlling spending in the first place. If you keep spending constantly going up beyond what you can do with this type of mild financial repression, it's kind of pointless anyway.
Yeah, and I mean, that's a problem. And I think that's why, actually, with politics, you always need to hit a wall at some point. There's got to be a pain point. That did get hit in the 70s, and so things changed. And I think probably something similar will have to happen this time round, whether we like it or not.
And it feels like it can't be that far off. Debt to GDP, 100%.
Yeah.
It's ridiculous. Do you remember the days, not to keep harping on about how long you and I have been speaking, John, but do you remember the days when we used to consider a country to be all but bankrupt when its GDP, debt to GDP ratio was 80%? Do you remember that?
Yeah, and I remember the deficit rule as well for the EU it's like 3% deficit is getting on for bankruptcy.
Dare to dream, UK politicians.
Yeah.
Yeah. Right. Anyway, on to more interesting stuff than the sort of, slow motion crisis that one day won't be slow motion anymore. And then we really will want to talk about it. I wanted to talk about the latest Bank of America Global Fund Manager Survey just out for this month. And this is kind of interesting because they ask the same questions every time. One of them being, what do you expect the best performing asset to be over the next 5 years? And suddenly, instead of everyone going, oh yeah, American equities, definitely, always, forever, 54% of them have said international stocks. Only 23% have said US stocks. And that, it's kind of a turnaround. This is not to say, for example, by the way, that their portfolios will reflect what they have said.
Yeah.
If they did, markets would be performing very, very differently because the flows out of US equities would be so huge. But nonetheless, it reflects a sense of change, right?
Yeah, I mean, I love the Global Fund Manager Survey. It comes out every month and it's a really useful sense of market sentiment. And some of the elements of it, you can trade against. You can say, I'm going to take the contrarian view on this. But other bits, probably like this one, are more indicative of trend changes. It's kind of gratifying to see because we've been talking about how, basically we need flows to come out of the US, or at least not go into the US as much and start going everywhere else. And that would help the UK as well as all, the other kind of neglected global markets. So it's nice to see that in theory, at least, fund managers do believe this now. They think it is time to go back into diversification. They clearly think the US exceptionalism theme has kind of run its course. They're very bearish on the dollar, which is probably the one area where I think the level of bearishness implies that we could get a short-term bounce back. But even then, it's probably only a short-term thing rather than a longer-term big shift.
Yeah, and then I'm looking at the biggest tail risks that they think there are out there. Trade war triggers global recession. Is that a tail risk if everyone expects it?
Everybody thinks it's kind of unlikely or wants to think it's unlikely. I think we've been so long without a proper recession that people can't quite wrap their heads around the idea that there might be one. If you ask me which of the two outcomes, no recession or a recession, I had to bet on, I wouldn't have high conviction, but it'd be more no recession because I think it's going to be more like inflation, nominal GDP growth type of thing.
What if I gave you mild recession?
Yeah, but then I think a mild recession's kind of like no recession in an inflationary environment because your economy's still growing, it's just not growing properly. It's not growing in real terms.
Fair enough. If anyone's interested in whether there's going to be a recession or not, please listen to this week's interview podcast on Friday. There's a lot in there about whether recessions have been cancelled completely. We will never see the like of the recessions of the previous century again.
Oh, is this the one with Vincent?
Forever. Absolutely.
Oh, he's so very interesting guy.
Good. Yeah, and we talked about, one of the main things behind this idea that there won't be another recession is the idea that the capital cycle is different in an intangible economy. But then I would still worry slightly about AI because the capex there has been massive. There's definitely a capital cycle there. But we'll come back to this another time. The other bit I wanted to point out in the survey is, what do you think is currently the most crowded trade? And the answer, this is not what is the most crowded trade, it's what people think the most crowded trade is. And the answer there at the moment is long gold, which is the third month running that people have thought that other people are in a crowded trade, right?
Yeah, I mean, the crowded trade question is a really interesting one on the BoA thing because when you look at it, it doesn't tell you much that's actionable, I wouldn't have said.
Oh, I don't know. I think it doesn't it tell you something? It tells you, look, 41% of people think that long gold is the most crowded trade, but only 13% of people think that gold will be the best performing investment over the next 5 years. See, I look at that and I think that means that they think that more money is in gold than really is, which suggests that gold might have further to go.
Okay, yeah, that's fair enough.
Or maybe you could argue it the other way around. I don't know. Anyway, I just think it's interesting.
It's tricky, looks. If you look at, if you look at the, like long Mag 7 was the main thing that they thought was a crowded trade, but they thought that for about nearly like 5 years, give or take. There was a couple of moments where they said, everybody's too long Chinese equities in October 2022, that was. I guess that was when interest rates were coming down. But so I don't actually know how much kind of value that particular discussion has. But it is the first time that long gold has been cited as the most crowded trade.
Yeah, well, third month in a row.
Yeah,
but we've got their chart. We've got
a
chart that goes back to October the 14th here, which tells us what people have thought the most crowded trade is for a long time. And when you run through it, it's basically all America. Long dollar, long NASDAQ, long US tech, long dollar, long Magnificent 7, and then there are brief little bits in there where for about 5 minutes people went long China equities, long crypto, et cetera, et cetera. But in the end, this is basically for the last decade it's been all about America, and now suddenly it's about gold.
Yeah.
I don't know what the signal is there, but it's definitely a signal.
Yeah, and well, maybe it is. Maybe it's people. The accepted wisdom becomes that gold's too expensive, but you can't not own it. The same as it was with the US. The US is too expensive, but you can't not own it.
That would be fun for those of us who hold gold.
Oh, that'd be great.
One more thing to mention briefly was that if it is true that investors are beginning to believe that the US will not be the best performing place for the next 5 years, and they really believe that the best place to be is either European equities, and I'm going to include don't be upset, listeners. I'm going to include the UK equities inside European for the purposes of this conversation, because I suspect that for a lot of big American investors, they're kind of the same thing. And we were talking last week about flows, or I was writing about flows last week anyway, and about how there are two, when you look at equity markets, you have to think about two things. You have to think about the fundamentals and the valuations long term, what that means. But you also, more important than that, in the short and medium term, you have to think about the flows. So this massive outperformance in the US has all been about piles of money pouring in. Stock prices are about supply and demand in the end. And in the UK, we have shrinking supply. We've talked about this a lot, right? We have endless companies being taken out, private equity or just giving up the ghost altogether, mergers, etc. A lot of companies leaving. The market has really, really shrunk. So we have a shrinking supply. If we get even the slightest real tick up in demand, we might see something really quite interesting happen.
Yeah, I think it'd be great. The US has benefited so much, and as you pointed out, so much of the growth in the US market was down to valuations expanding rather than fundamentals getting better, even though fundamentals were good.
Fundamentals were good. Last decade they have been good, but not unusually good, not uniquely good.
Aye.
Much the same as most other decades in the last 100 odd years of US history.
Yeah, and it's just that probably relative to everyone else, average was better than what we all got. So it'd be really interesting. The other thing I'd be really interested to see is, given the concerns over private equity, if the trend of de-equitisation actually starts to turn around again, or if that's just not going to happen. I mean, there was one thing I wondered about private equity, and I don't know what your take is on this, but what if the volume of money going into private markets is basically a function of passive, making it no longer profitable to essentially be involved in public markets, and the scrutiny putting people off. And what actually happens is that private markets start to move back towards being semi-liquid, semi-public, and we kind of get a weird circle where it comes back that way, rather than private equity blowing up or something and then everyone just going back to the old way of IPOing.
Yeah, that's really interesting, and we should refer listeners back to the podcast earlier this week where we were talking about private equity, and we were talking about this idea of semi-liquid private equity products where you could get your money out twice a year, etc., which I think slightly defeats the whole object of what we were always told was the most brilliant thing about private equity was its illiquidity, and that's where you get your excess return from. And if you don't get excess return from that, where do you get excess return? But it is an interesting point that it could be that it comes back around that way, and we've seen this the new exchange in that we will be having in the UK as well, which is again an exchange for private companies. So it may come back that way, but I still hope that we will see a return to public markets, in that when the average investor looks at the fact that the returns from private equity and the returns from public equity are remarkably similar, surprised with them both being equity, but they can get the returns from the public markets at a lower cost and with significantly more transparency and with significantly more certainty around the governance and compliance of the management. So I would have thought that might bring people back to the public markets. But again, we'll see. There's nothing about that in the Bank of America survey, I'm afraid. Perhaps you get them to add some questions in on that kind of thing. You call them, John.
I shall.
Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to your podcasts. Also be sure to follow me on X at MerrynSW and John at John_Stepek. This episode was produced by Moses Andam and Summer Sadi. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.